Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Jbg Smith Properties annual report. Jbg Smith is a company that specializes in developing and operating mixed-use properties in the Washington, D.C. metropolitan area. Their focus is on creating vibrant neighborhoods with high-quality amenities that appeal to residential, office, and retail tenants. The company's portfolio consists of multi-family, office, and retail assets, totaling 11.8 million square feet, with a significant presence in the National Landing submarket in Northern Virginia. This submarket is driven by key demand drivers such as Amazon's headquarters, Virginia Tech's Innovation Campus, proximity to the Pentagon, and Jbg Smith's own placemaking initiatives. Jbg Smith services include property development, operation, and management of mixed-use properties, with a focus on creating green, smart, and healthy buildings. Their business model encompasses various aspects, including property ownership and operation, mixed-use development, placemaking, and public infrastructure, improvements, multifamily, office, and retail asset management overall. Jbg Smith is a leading developer and operator of mixed-use properties in the Washington, D.C. metropolitan area, with a strong focus on creating vibrant neighborhoods that meet the needs of residential, office, and retail tenants. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to increase. The stock price of Jbg Smith Properties has increased slightly over the past year due to several factors. One key reason is the company's strong financial performance. As a real estate investment trust, REIT, Jbg Smith Properties generates revenue through property ownership and management, which has been stable and growing in recent years. This stability and growth have contributed to investor confidence, leading to an increase in stock price. Another factor that may have contributed to the increase is the company's strategic investments in emerging markets such as Washington, D.C. and Maryland. Jbg Smith Properties has a significant portfolio of properties in these areas, which are experiencing rapid growth and development. The company's ability to adapt to changing market conditions and capitalize on new opportunities has likely boosted investor interest and driven up stock price. Additionally, the overall real estate market trends may also be contributing to the increase in Jbg Smith Properties' stock price. A strong economy, low unemployment rates, and increasing demand for housing and commercial space have all contributed to a favorable environment for real estate investments. As investors seek to capitalize on these trends, they are likely driving up demand for REITs like Jbg Smith Properties, which has led to an increase in its stock price. It's worth noting that the stock market is inherently unpredictable, and there may be other factors at play that have contributed to the increase in Jbg Smith Properties' stock price. However, based on the company's strong financial performance, strategic investments, and favorable real estate market trends, it is likely that these factors have played a significant role in driving up its stock price over the past year. Jbg Smith Properties' market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Jbg Smith Properties trades at a lower price-to-book ratio of 0.79 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 56% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The company have a dividend yield of 4.44%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for companies in the real estate industry can be summarized into several key areas. Rental income is a significant contributor to revenue, with changes in rental rates, occupancy rates, and lease terms impacting overall revenue. Third-party real estate services revenue also plays a crucial role, as fees earned from providing management, leasing, and other services contribute significantly to revenue. In addition to these factors, the amortization of lease intangible liabilities can provide a steady stream of revenue over the life of the lease. Net operating income, NOI, is another important metric, as changes in NOI can impact revenue by representing the difference between rental income and operating expenses. On the other hand, drivers of revenue decline include decreases in rental income, declines in third-party real estate services revenue, and changes in lease terms or occupancy rates. Increases in operating expenses also contribute to a decline in revenue. Overall, companies in the real estate industry must carefully manage these factors to achieve revenue growth and maintain profitability. The net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it transitioned from a loss of $91.7 million in 2023 to a loss of $177.8 million in 2024. However, this trend reversed in 2025, with the net loss decreasing further to $168.1 million. The net income also decreased by $9,692, minus 5.5%, from 2024 to 2025, and by $6,008, $30,041, $24,033 during the same period. Profit margins experienced a substantial decline between 2024 and 2025. They decreased by $49,051, minus 88.3%, during this time frame. The operating income loss increased from minus $14,195 to minus $9,006, but the net loss still decreased from minus $30,041 to minus $24,033. Despite a gain on the sale of real estate of $46.6 million, profit margins were negatively impacted by a net change in operating assets and liabilities of $10 million. The reasons behind these changes in net income and profit margins are unclear based on the provided information. However, it is evident that the company faced significant financial challenges during this period, with both net income and profit margins experiencing substantial declines. The company's financial performance has shown a significant improvement in recent years. One key indicator of this success is its ability to generate positive operating cash flow. According to the annual reports, the company achieved a substantial operating cash inflow of $73,257 for the year ended December 31, 2025. This achievement is further reinforced by the detailed financial data presented on page 79, which provides specific numbers for each year. The consistent generation of positive operating cash flow demonstrates the company's ability to manage its finances effectively and maintain a healthy cash position. This trend suggests that the company is well positioned to continue its growth trajectory in the future. The company's debt level has seen a moderate increase over the past year. As of December 31, 2025, the total debt outstanding stood at $2.6 billion, which represents an increase of $120 million from the previous year. While there is no significant change in debt level or interest expenses mentioned in several sections of the report, one notable exception is the increase in interest expense due to new assets with interest expenses no longer capitalized. A more substantial increase in interest expense was observed, rising by 5.9% to $142 million in 2025 compared to $134.1 million in 2024. This change can be attributed to various factors, including the reclassification of fair value from accumulated other comprehensive income loss to interest expense and the impact of hedged forecasted transactions on earnings. The company's use of derivative financial instruments has also been noted, with a significant decrease in total assets and liabilities between 2024 and 2025. However, the interest expense related to non-designated derivatives is not specified for either year. The presence of mortgage loans and term loans as part of the debt further highlights the complexity of the company's financial situation. In conclusion, while there are some fluctuations in the company's debt level and interest expenses, a significant decrease in debt level has not been clearly indicated. The performance of various segments and regions within the real estate services business has been mixed. On a positive note, the third-party real estate services business saw strong growth, indicating a healthy demand for its services. However, not all areas fared as well. The U.S. federal government segment experienced significant revenue declines between 2023 and 2025, with a decrease of 12.4% from 2023 to 2024 and another decline of 14.1% from 2024 to 2025. In contrast, certain geographic regions showed promising results. The Washington, D.C. metropolitan area, high-impact neighborhoods, and Charlotte, North Carolina all performed well, suggesting a strong market presence in these areas. Management is expressing cautious optimism about the company's outlook. Despite reporting net losses in 2025, the company is focused on maximizing the use of observable inputs from its portfolio of properties with leases that generate rental income and operating cash flows. To achieve this goal, management is actively managing debt by entering into interest-only mortgage loans to refinance existing debt or finance new acquisitions. This strategy will help the company maintain its qualification as a REIT, which requires it to satisfy two gross income requirements. 75% of gross income must come from real property investments or related activities, and 95% of gross income must come from real property investments, dividends, interest, and capital gains. Management is also committed to distributing required amounts to shareholders, including at least 90% of REIT taxable income and net after-tax income from foreclosure property. While the company faces challenges such as environmental liabilities and potential changes in insurance coverage, management remains focused on executing its strategy and creating value for shareholders. The company's strategic moves through acquisitions and divestitures have been a key aspect of its growth plan. In terms of acquisitions, the only notable mention is the Formation transaction, which is detailed on page 86. This transaction appears to be a significant event for the company, but further details are not provided in the extracted summaries. On the other hand, the company has also engaged in divestitures as part of its strategy. Specifically, it has disposed of multifamily, commercial, and or retail assets, as well as land, with the aim of funding development and investment plans, page 24. This suggests that the company is actively managing its portfolio to optimize resources and achieve its goals. The company has a history of paying dividends to its shareholders. This is evident from the various references provided, which highlight the company's commitment to rewarding its investors through dividend payments. The payment of dividends demonstrates the company's financial stability and ability to generate consistent returns for its shareholders. By distributing a portion of its profits to shareholders, the company acknowledges their investment and shows appreciation for their continued support. Concerns about inventory buildup or supply chain disruption are evident in the provided summary. On page 18, potential disruptions to the supply chain are highlighted due to various factors such as contractor disputes, labor shortages, and weather conditions. These issues can lead to delays and inefficiencies in the delivery of goods and services. Furthermore, on page 20, zoning issues, legal challenges, and changes in entitlement processes are identified as potential causes for supply chain disruption. These regulatory hurdles can slow down or even halt construction projects, resulting in a ripple effect throughout the supply chain. In addition to these supply chain concerns, there is also evidence of inventory buildup on page 52. The softness in multifamily portfolio occupancy and decrease in effective rents for new leases suggest that demand is slowing down, leading to an accumulation of unsold or unrented units. This can put pressure on developers and property owners to manage their inventory levels effectively to avoid further losses. That concludes the financial summary for Jbg Smith Properties. Feel free to comment below, and I will be happy to answer them when possible.